Year to date, the macro backdrop has been characterized by heightened inflation, rising interest rates, and geopolitical uncertainty. This has made for a challenging stock-picking environment during which the global sustainability strategy has underperformed the benchmark. On a one-year basis, the strategy continues to outperform, and we've held up relatively well versus the peer group. This is due to us having repositioned slightly during the year to benefit from inflation beneficiaries, stocks that have better pricing power in the backdrop of inflation, and also because we have avoided the ultra-high growth technology sector where the derating has been most pronounced. Since the beginning of the year, we became aware that inflation was likely to continue to rise. And with escalating geopolitical tensions, our conviction in the rising interest rate and rising inflation backdrop heightened. So in response to this backdrop, we did buy a basket of inflation beneficiary stocks. We maintain a core holding of quality growth, which we believe is the right place to be structurally due to the structural growth that these companies will enjoy. But on the margin, repositioning slightly to enhance the inflation beneficiary exposure, I think is the right decision in light of the macro backdrop. During the second half of the year, energy transition is likely to be a key theme because countries face energy insecurity. So investing in homegrown energy is likely to be a strategic priority, not only for governments, but also for companies looking to ensure reliability in their supply chain. Another key theme, we believe, will be a reshoring of manufacturing. Supply chains over the last 20 years have benefited from globalization, but we now expect to see inbuilt redundancy as supply chains consolidate nationally and manufacturing is brought home so that resiliency is improved. We're very clear on our process for identifying the stocks we want to own, being a trifecta of quality, growth, and valuation. So when we're looking at quality, we include assessment of a company's environmental, social, and governance footprint. We have a screen which identifies the best in class versus the worst in class on this environmental footprint metric. But we also look at the company's products and services and the extent to which they are going to grow, perhaps because of a tailwind coming from sustainability. So this is where sustainability also features in our assessment of the growth. And we are very clear in the global sustainability team that we don't want to overpay for the companies that are high quality and growing well. Often these companies come at very expensive prices because they are most resilient to the changing business cycle dynamics. So we have to be very prudent to find those companies which fall in the Venn diagram of all three of the quality, growth, and valuation framework. The global sustainability strategy is to identify companies that are exposed to structural growth drivers, and often these come from sustainability growth drivers. So we are looking for the enablers of a sustainable transition. We identify the best in class, and we have most of the fund based in and invested in this best in class category. And we also allow 25% to be invested in improvers. These improvers may not have the best rating yet, but we can work with these companies through investment stewardship, meaning we can engage with the companies in response to the research that we've done that identifies areas that maybe the company can improve. And then we also use proxy voting to add a stick to the carrot of our engagement and hope that the company's actions improve these metrics so that perhaps they can attract a wider group of potential investors such that the stock re-rates and we benefit from the company's improved sustainability reflected in a higher stock price. That's the idea, and that's the strategy that we pursue.
Allianz Global Investors.